I always, when I'm doing my resident seminars, and you've probably heard me do this at a dinner, where I say, what are the two biggest drags on investment performance? And it's taxes and fees, depending on the account, obviously. But those are things that doesn't matter what the investment is, those things apply in some way, shape, or form. So it's not what you make, it's what you keep. It's, it's not what you keep, but it's how you grow it and how you invest it and where it's invested and all those kind of things. And then I love how you framed that you've got to buy something that somebody else is going to want again at some point, and hopefully more than they want it now. And for most of the people listening to this, it doesn't mean like, okay, do a ton of research into the individual stock that you're going to buy, because most people aren't going to buy stocks, or if they are, it's not going to be a big part of their retirement portfolio, hopefully.
Right. It's smart not to do that. It's safer. I think I've done a little bit of trading myself, and if it's taught me anything, it's keeping your capital, keeping the money that you use to try to make more money it's both the most important and the most challenging part of investing, because, potentially the bigger you invest in something, the more you make. Anytime something is really successful, you never invested enough. And anytime you lose money, you always invested too much.
Yep.
Like that's how it feels 100% of the time. So, creating a plan and sticking to it is the key. This is all still big picture stuff, but keeping the money you have is almost more important than the performance, but not to the detriment of your growth.
Yeah.
So holding it in cash is not a great plan. And pretty much anybody would agree with that, especially when, do you know this? I looked this up. 22% of the US dollars in circulation right now were created this year. 22% of all US dollars.
Boy, with the ramifications that has for inflation and everything, like that's crazy.
Yeah. I looked it up. You can look it up on one of the government, Federal Reserve websites, how much is in circulation, how much is printed this year. Cause you can just look at 2019 versus 2020. It's a 22%, increase. So it's not even, I was like, this has got to be fake news. That's too high, but no, it's the real deal.
You're talking about printed cash or just anything in cash or money markets or derivatives like that?
That's a good question. I think it's probably printed cash, to be honest, how much they printed, because there's no way it's the total amount of US dollars out there. So
no, I figured you meant the GDP went up 22%. Like, whoa,
that would be nice.
Maybe since March or April, but yeah. No, I've had this recently. This morning, I looked at a stock that I bought of a company that I know, and in the last 2 days, it's gone up 30%. And, have that same age-old conversation. Should I take my winnings and walk away or leave it there? And it's like, honestly, I'll probably sell some and leave the rest of it invested. It's just,
and it depends on what your plan is. The key is to make a plan. If I put in this much money and it goes up this much, then I'm going to take this much out. And that's really to a degree, it's not literally day trading, because you're not opening and closing a trade in the same day. I think that's the definition of that. But it's kind of like day trading. It's just that you're not looking at it quite as much and you're waiting a bit longer. It's a short-term approach. It almost doesn't qualify as investing compared to what we would normally talk about with residents, which would be retirement accounts and what can you do. What is a retirement account and what can you do with the funds inside of it? Because even that's a mystery to people. They might put, a few grand into a Roth IRA every year for residency, and that's a post-tax. So all the growth that you get in a Roth account, that's pretty much the only difference, right? Between a regular IRA and a Roth IRA is that you've already paid the taxes. You contributed with the money that you already paid taxes on. So then it's a limited amount. You have to, the only way to contribute to that is if you make less than, 135,000 for single and some sort of combination in the 200 or 300, I think, when you're married.
Yep.
Regardless, it changes a little tiny bit every year, and you can always look it up on the IRS website. But so you put a little bit of money in there, and it's like, what can you do with it? Well, you can't just put it in. It doesn't just start growing. You have to pick things that you buy within the IRA. And at least one of the books I read, that's apparently a common thing that'll happen for the occasional person. They'll put the money in. They're just like, why isn't it going up? They'll check back a year later. They missed a whole year of growth. They just deposited in there. They just assumed, somebody was making it grow, but you have to actually buy specific funds when you invest. Some some companies will set it up automatically. You have to pick one when you open the account, but most of them will not, or Vanguard necessarily will not. And some of the lower fee ones are a little more hands-on. So you have to pick your own, either a retirement fund, or
right.
You can buy specific stocks, but generally buying a group of stocks is the approach of either a mutual fund or a retirement account.